You can pay zero taxes on over $125,000 of retirement income, and in this video, I'm going to show you how. One of the greatest benefits of retirement income is that you can control how you are taxed by carefully pulling income from different sources, like your Social Security, your retirement accounts, your taxable accounts, capital gains, dividends, and other forms of income that you may earn. Each of these income sources are tax-free up to a certain level, and when you understand these levels, you can begin to pull tax-free income out from each of them during your retirement. So I'm going to show you a realistic way to achieve a tax-free retirement by sharing my experience as a licensed CPA that tax plans every day at mycpacoach.com. So let's jump right in. Okay, let's start with identifying your first $30,000 in tax-free income. And this can apply to virtually any taxable income that you earn, such as your W-2 income, your business income, or income you withdraw from a traditional IRA or pre-tax 401k, which is normally subject to income tax. So here's the thing, if you are married, you qualify for a $30,000 standard deduction when you file your taxes, which means if you earn $30,000 in taxable income, that deduction would eliminate 100% of your income, leaving you with zero income left to pay taxes on. Plus, if you're over the age of 65, you will qualify for an additional tax deduction up to $3,200 if both taxpayers are above the age of 65. Now, if you are single and over the age of 65, you will benefit from a $15,000 standard deduction plus an additional $2,000 deduction, allowing you to earn up to $17,000 in tax-free income. And that's just the beginning here. So right off the bat, we have $30,000 in tax-free income, assuming you are married. Now let's add another $32,000 through tax-free Social Security income, and then I'll give you some even bigger strategies to consider here. So Social Security income is exempt from taxation when your combined taxable income is less than $32,000 per year for married taxpayers and less than $25,000 for single taxpayers. Now, to fully understand this, it is very important that you understand how taxable income works, because this is the remaining income on your tax returns after taking all deductions. So if you recall in the first example where the married couple took a $30,000 standard deduction against $30,000 of their income, well, they were left with zero taxable income in that case. So if we added another $32,000 in Social Security income, it would still be tax-free because the taxable income is still within range here, essentially allowing us to earn up to $65,000 in tax-free income once we factor in that additional $3,200 deduction. Now, once you earn above the tax-free Social Security income limits, anywhere from 50 to 85% of that income may be subject to taxation. But that doesn't mean you have a 50 to 85% tax. Let me explain. Let's say you have $9,000 in Social Security income above the income threshold. Well, only half of that, or $4,500, would be considered income on your tax return, which would subject you to ordinary income tax unless you are able to use the standard deduction or other deductions to offset your income, which is why understanding these limits are so important. So that's the basic stuff. Now let's move on to the next big opportunity, which may allow you to earn up to $100,000 in tax-free income alone. This strategy helps you take advantage of the 0% capital gains rate, which you can use to pay $0 in taxes regardless of your age. So here's the deal. For the 2025 tax year, if your taxable income is less than $97,000 as a married taxpayer, or $48,000 if you file as single, you will pay a 0% tax on long-term capital gains and qualified dividends that you have. But in order to make this work, it is critical that you understand what long-term capital gains and qualified dividends actually are and what they are not. Long-term capital gains occur when you hold an investment for longer than 1 year and sell it for more than what you paid for it. And what is key to understand here is that only the gain is taxable, not the amount that you paid for it. So for example, if you sold $100,000 of stocks that you paid $60,000 for, only $40,000 of that amount will be considered a long-term capital gain. And if we went back to our original example, then this would only add about $40,000 in capital gain income, which would still trigger $0 in taxes owed on this portion of income. So when it comes to tax planning around capital gains, please remember that the amount of the sale is not your income. Only the gain is considered income. A $200,000 sale with a $100,000 cost basis is just a $100,000 capital gain. This is very important to understand when you're trying to maximize your tax-free income. Now let's touch on dividend income quickly here for a moment, as many people rely on some form of dividend income, especially during retirement. So let's talk about how to avoid taxes here as well. So look, there are two types of dividends: ordinary dividends and qualified dividends, and they are taxed differently. So be sure to pay attention here. Ordinary dividends are taxed as ordinary income, which we want to typically avoid if we have already maxed out our standard deduction. Because once your earned income exceeds the standard deduction, it will begin to be taxed at 10%, then 12%, and so on, which are still very low tax rates to be honest, but you need to be mindful of this, especially if your goal is tax-free income. What we'd rather have is qualified dividends, because these dividends are taxed at the long-term capital gains rate, which would allow you to take advantage of that 0% tax rate that we just discussed, or just pay a lower rate of tax in general here. So if you earn dividend income already, make sure you know what type of dividend you are earning so that you can tax plan accordingly. And also keep in mind that this strategy does not apply to gains in your retirement accounts or qualified withdrawals or distributions from those accounts. That income is either treated as ordinary income if it is a pre-tax account, or tax-free income if it is from a Roth account. And speaking of Roth, let's dig into that a little bit deeper. Now, if you're watching this, you probably already know that income generated in a Roth retirement account is tax-free if withdrawn correctly during your retirement. But here's the catch that a lot of people miss. It defeats the purpose to withdraw from your Roth when you are already in a 0% tax bracket, or could be with smart planning. Remember, the Roth strategy is all about paying tax upfront while you are in your working years so that you can avoid high tax rates during retirements when you are in a higher tax bracket. But if you are in a low tax bracket now and you have access to other sources of tax-free income like capital gains under the threshold, tax-free Social Security income, or standard deduction room, it may make more sense to use those up first. That way you can preserve your Roth for future years where it actually saves you more money in taxes because you are in a higher tax bracket. This would just help you stretch your retirement income even further without paying additional taxes. And to that point, it may be even smarter to consider a Roth conversion. This is when you move money from a pre-tax retirement account, like a traditional IRA or traditional 401k, and you move it into a Roth IRA. And yes, you will pay tax on that amount when you convert it. But here's the key benefit. If you have a lot of money in those pre-tax accounts, the IRS will eventually force you to take a required minimum distribution starting at the age of 73. And those are fully taxable to you at whatever tax bracket you happen to be in at the time. So to avoid being hit with high taxes in the future, many of our clients start doing Roth conversions while they are in lower tax brackets. Since distributions from traditional IRAs are taxed as ordinary income, we typically try to help our clients trigger taxes at the lowest tax rate possible, often by taking into account their standard deduction and opportunities where they may be in a lower tax bracket. For example, if you are married and have no other income, the first $30,000 of this conversion would be completely wiped out by the standard deduction, meaning no tax at all. And then the next $24,000 will be taxed at 10%, and the next $73,000 taxed at 12%, which may be a huge opportunity to move money into a tax-free account while paying very little tax to do so. But ultimately, your decision to convert or not will depend on your expected tax bracket in the future, your RMD exposure, and your income needs, which is why tax planning is very important during your retirement. Remember, as a retiree, you have the advantage of being able to control your income, control when you sell investments, and when you withdraw or convert your retirement funds so that you're paying as close to $0 in taxes as possible. And if you're already paying a lot of taxes and you need help with this, just go to mycpacoach.com to get a tax plan that is guaranteed to reduce your taxes. Thank you for watching.